Good afternoon, everyone, and thank you to the CFA Society for having us here today. I'm Jake Green, and accompanying with me today, Bradley Heller, Zach Landers, Matt Nelson, and Jake Sorensen, and together we make up Team 3 of the University of Minnesota Duluth. We're excited to be here today as we present to you Polaris. We're issuing a buy recommendation of shares of Polaris with a 12-month price target of $99, implying an upside of 6.8% from current price levels. We derived our price target from discounted cash flow analysis coupled with price earnings multiples valuation. Our thesis was supported by 3 main catalysts, including new product innovation, vertical integration, and the quality of the dealer chain. Matt, what exactly does Polaris do?
Thanks, Jacob. Polaris is a vehicle and parts manufacturer headquartered in Medina, Minnesota. The company operates under 3 main product segments. Off-road constitutes for 75% of Polaris' revenue, which includes side-by-sides, snowmobiles, UTVs, and ATVs. On-road accounts for 13% of revenue and includes Indian motorcycles and slingshots. Marine is 12% of revenue and is made up of pontoon and deck boats. Jake, do you want to touch on the catalyst?
Of course. Now getting into our catalyst. Our first catalyst is Polaris' new product innovation. Polaris has been at the forefront of innovation for decades with new additions like the Expedition and Ranger XD 1500. The company has also set some interesting production improvement goals for themselves moving forward, notably the pursuit of manufacturing off-road vehicles with 90% recyclable content by 2035. And expanding more of their product line into electrified products to enter a new market that's set to achieve a 19% industry growth CAGR between 2024 and 2032. Additionally, Polaris has trademarked a new cutting-edge transmission for their side-by-sides that maximizes durability and performance of their products. Our second catalyst is Polaris' vertical integration efforts. Polaris has chosen to pledge $350 to $400 million in capital expenditures per year over the next 2 years to expand upon their manufacturing capabilities as well as expand the capacity at which they can achieve. To illustrate these efforts, the company has invested internationally in an off-road manufacturing facility as well as a mid-sized motorcycle engine facility to continue diversifying their production line. We believe that these efforts warrant margin improvement going forward. Our last and final catalyst is the quality of Polaris' dealer channel. Through a proprietary survey of Polaris' dealers in northern and central Minnesota, it was concluded that Polaris has a competitive edge. Within our survey, most dealers said that they see sales increasing over the next 12 months, and all dealers surveyed touted Polaris' products as being superior to that of competitors, despite having other brands in inventory. Furthermore, every dealer of the handful stated that Polaris treats them above average when it comes to dealership relationships, with kickbacks and special financing options for consumers. From these findings, we can clearly see that Polaris has a competitive edge. Zach, would you like to touch a little bit on the industry?
Sure thing. Thank you, Jacob. Polaris makes over 60% of their revenue from personal and recreational vehicle manufacturing, which is power sports manufacturing, excluding on-road and marine sectors. As you can see from the pie chart on the right, these are the top 5 players as follows. Yamaha with 50% market share, Polaris 24%, VRP, ticker DO 12%, Textron 8%, and Kawasaki 4%. These top 5 players account for over 90% of the revenue within PRV manufacturing, hence the low threat of new entrants, but high competition amongst existing competitors. These firms all have similar product mix, so we felt it was fair to compare their financials. When conducting our competitive analysis, we had the goal of determining if the power sports industry is an attractive investment. Polaris was outperforming the market in sales until 2021, where sales have slowed since, but Polaris has still managed a 6% top-line CAGR with underperformance on the EPS CAGR in comparison to competitors BRP and Yamaha, who have seen better stock performance over the past 5 years. As you can see from the price to earnings valuation, the industry as a whole has taken a hit, but Polaris has seen the most retraction, with its price to earnings being under half of its 5-year average. This only furthers our conviction in Polaris being undervalued and our conviction in the $1 billion share buyback program. The power sports industry as a whole projects solid growth through 2032, and we believe Polaris is positioning themselves well to capitalize on this new market and also regain market share they once had more of. Polaris' margins have stayed relatively flat over the last 5 years. whereas the industry has caught up to Polaris' once superior margins. We feel Polaris will achieve increased efficiency through strategic CapEx allocation in capacity, capability, and vertical integration. Polaris specifically struggled with employee turnover during COVID, another reason we feel that margins will continue to expand. Although the industry as a whole might have a tough year ahead with sales, look to see margin expansion from Polaris. And now I'm going to hand it over to Riley to talk about ESG.
Thank you, Zach. At first glance, Polaris doesn't have the most impressive ESG profile. So what are they changing? Environmentally, Polaris has significantly improved on these three metrics over the past 5 years, reducing greenhouse gas emissions by 12.7%, growing its renewable energy portfolio to 19.1%, and increasing water conservation by 33.7%. By 2035, Polaris expects a 50% reduction in greenhouse gas emissions, 75% renewable energy, and the implementation of water stewardship programs in 100% of manufacturing facilities. It is also worth noting, Polaris has launched the Ranger XP Kinetic, its first electric-powered utility vehicle. Moving into our social factors, Polaris maintains proactive management of their safety initiatives, making it the company's #1 priority. Examples of this endeavor include their voluntary recalls, proper safety training, and strategic partnerships. The effectiveness of these initiatives can be seen in their total reportable incident rate. Additionally, Polaris is making continuous efforts to implement diversity and inclusion into its business through women empowerment, goals to increase diversity, and customer engagement, offering opportunities for feedback and creating a community through various Polaris-hosted events and platforms. Lastly, Polaris has a tenured management team and diverse board, further supporting our argument. Both Mike Speetzen and Bob Mack receive the majority of their compensation in either stock or options, signifying their belief in the company's ability to grow. I'll now hand it over to Matt for the financial analysis.
Appreciate it, Riley. Moving on to financials, we're expecting 2024 sales to be $8.5 billion and 2024 EPS to come in at $8.25. Over the next couple of years, Polaris plans to use an intriguing capital allocation strategy to drive returns for shareholders. First, Polaris plans to spend $350 to $400 million in CapEx in 2024 and 2025, well above normal levels around $250 million, in order to expand manufacturing capacity and create a more efficient supply chain process. Although this CapEx may be tough for Polaris to stomach in the short run, we expect to see margins improve over the next couple of years. The next major piece of the capital allocation strategy is Polaris' share buyback program. Polaris expects to buy back 10% of shares by 2026. If these shares are bought back at reasonable prices, it could create a lot of value for shareholders. Finally, Polaris recently announced a dividend increase in February, marking their 29th consecutive year with a dividend increase. Although the increase is less than 2%, investors looking for a steady stream of income can count on Polaris to pay dividends for years to come. Jacob, let's hear a little bit about the valuation.
Thanks, Matt. So, to calculate a 12-month price target for Polaris, we conducted a DCF analysis which indicated an upside of 6.8%, supported by three identified catalysts. We used a short-term free cash flow growth rate of 10%, long-term free cash flow growth rate of 5%, and a terminal growth rate of 2%. With that, utilizing a WACC of 7.98%, we were able to discount these future cash flows and arrive at a price target of $99. To support our intrinsic valuation, we used a price earnings multiple of 12 times and an earnings per share of $8.25, giving us a 12-month price target of $99, implying a 6.8% upside. As you can see in the chart, Polaris is trading at a lower multiple compared to competitors in the industry. With that, we believe Polaris to be undervalued. Jake, could you touch on our risks?
We have identified 4 key risks when evaluating Polaris. The first is macroeconomic trend risk due to the discretionary nature of Polaris' products. Second is brand reputation. Polaris has built a sturdy reputation for being a quality market innovator, and any adverse action taken by Polaris could affect the demand for its products in the future. Third is manufacturing and supply chain risk, with Polaris being highly sensitive to input costs and supply chain disruptions, and a failure to vertically integrate could pose a significant risk for the company. Last is litigation and recall risk, with Polaris being subject to increased regulatory scrutiny and recalls like we've seen in the past. Now, Matt will conclude.
Thanks, Jake. We are reiterating our buy recommendation on shares of Polaris with a 12-month price target of $99, implying an upside of 6.8% from current levels. We would now like to open the floor to any questions you may have.
thought earlier in your presentation I heard a 24 to 32 CAGR mentioned of 19%. Did I hear that wrong?
Over that period, time period?
Yeah.
The CAGR for that time period?
Yeah. Because, yeah, I just want to question that math because that would imply that the revenue's going to double every 4 years, basically.
I believe that was electric vehicles.
Okay.
Oh,
I
yeah.
just want to clarify that. So the second is you got a buy rating on a company with basically a 6% stock opportunity the next year with plus dividends, and a stock that has seen, as you mentioned, $138. What's a more constructive case with a buy rating and a price target that doesn't quite rhyme, right? To me, as an investor. So what's the case to talk about something more like a stock returning to 138?
Right. At the same time, we don't see a bunch of upside. We still do see the company being undervalued. We would have loved to say 10 or double-digit growth within the stock, but it's the value that we derive through our price targets and our valuation. Yeah.
I touched on it a little bit. Yeah, part of the reason we have a buy recommendation, like our main thesis and how we differ from the street is on their margins. We're bullish on their margins going forward, just with all that CapEx they're going. So we think it might take a couple of years to really see those margins improve, but once they do, we think it go back up to those 138 levels if their margins are able to improve significantly going forward.
You know, the numbers for me is a little one-sided. You talk about new product, right? Just curious, have you thought about that adoption? Secondly, talk about the management is going to increase CapEx, increase dividend. Feels like interest rates going up. So what really is? I mean, have you thought about the EPS growth? How that's sustainable? And also, you avoided, feels to me there's another competitor that actually the numbers look margin, everything else looks better. So why do you have the confidence in Polaris?
Could you simplify your question?
Sure.
Time?
Sorry, yeah. I'm just trying to understand your buy rating because all the drivers you talked about. So my question is, how confident are you with your EPS growth projections, which comes from the top line, right? And then secondly, why have a buy rating in this particular company versus in the comp analysis there's a better margin company?
Right.
I don't think it was a secret that BRP has weathered the macro environment and COVID restrictions, I would say better than Polaris has. You see this, they've managed to keep sales up, they've managed inventory better, but we still feel confident in Polaris' ability to return to the levels that they were at efficiently. They're investing in capacity, capability, and vertical integration. We feel the elevated CapEx is going to pay off in the long run. It might be tough to stomach at the moment. But like you said with EPS, it's totally a margin story. Their margins, I'm not sure what they peaked at, but they're below their highest levels, and we see that increased efficiency returning to the business.
Just another main reason we're bullish on them is just their quality of their products and their just brand loyalty. We're all from Minnesota here. Polaris is huge here. We just believe that their loyal customer base is going to be able to keep their sales propped up going forward.
Maybe just taking a step back, could you unpack how you got to that EPS number? What's embedded in the revenue growth rate? What's the margin expansion that you're expecting?
So for our top line growth rate, I think we were sitting at like, let me pull it up here. So for our revenue growth rate, we were sitting at like 3.5%, and then for EPS, we're growing at, say, 2 point something along those lines, but I'm sorry, I don't know how to answer your question for that. What's the extent?
So, just follow up a little bit. You guys talked about the elevated CapEx trajectory a little bit as part of your vertical integration catalyst. Where do we see the benefits of that in your model, I guess? Because obviously it's a headwind of TCF in the near term, but where's the flow through? Is it top line or margin? Top line.
Like I talked about a little bit in the presentation, the industry as a whole, no matter what company you look at, does not project much sales top line growth this next year. That's just due to testament, high interest rates, discretionary product. So it's just really hammering the importance of margins. And like Matt touched on, tough to stomach these higher elevated CapEx, 350 to 400 million each of the next 2 years, whereas prior to that they're averaging 200 to 250 million. But we believe in their strategic team that they'll be investing correctly.
Yeah, just at the investor day we were at earlier, CFO Bob Mack said that he believes that they have 3 to 4 basis points of net margin that they could possibly see improving with all this CapEx. So it's going to be a tough couple of years, but if the story plays out, we believe the margins can improve pretty significantly.
If I have this wrong, I'm sure my fellow judges will correct me, but I think you guys might have been the first team today to mention the buyback program that management has in contemplation. I'd be really curious to hear specifically how that was incorporated into your valuation methodology.
Yeah, so specifically for, I'll touch a little bit on our multiples. We took a look at the rate at which Polaris has been buying back shares in the past as well. So what we did is we applied that 5 years share buyback CAGR. We applied that 5-year share buyback CAGR to per share count that was less available, and we came to our outstanding share count. And then just to touch a little bit more on shares outstanding, Polaris they still authorize, I think, around like I can't remember, it's like 1 point, can't remember the specific number, but they still have a decent ways to go on their share buyback program in terms of board authorization. So we feel like that could create a lot of value.
Yeah, like we said in the presentation, they're going to be able to buy back 10% of their shares. I mean, Polaris is a $5-6 billion market cap company, so a $1 billion share buyback program is huge. It could be if they time their buybacks right, and when they feel they're undervalued, yeah, it could be huge for the company.
So you have a lot riding on this management team and what they're telling you about what they're going to do. But if you were sitting on the board, you would have been probably hearing that from one of these two for 7 or 8 years, and you've seen that the stock's underperformed and the margins have been kind of in one direction. So, I mean, why would you believe them now?
It's a great question. You know, it's tough to trust a company that's been hit like they have. But I would just hammer the importance of the current macro environment with the discretionary nature of their product, along with the fact that the price to earnings multiple has been hit so hard.
Just to touch on that a little bit more, this management didn't come into a necessarily easy situation. They both came into as CEO and CFO around 2021, I believe is the correct number. And so that was like COVID disruptions, and then they went around, and then progressing further down the line, we're seeing macro slowdown, or discretionary spending slow down in terms of both for Polaris' products. So we just feel like they've had kind of a tough run of the mill of things, and I feel like there's a lot of upside for the future.
So guys, I'm curious, you're making a buy recommendation here. What specific data would you review as sort of an early warning sign that maybe your thesis is deteriorating?
Guys, any kind of consumer spending starting to decrease. Obviously, this is a super discretionary company. You know, some of those pontoon and deck boats upwards of 100,000, snowmobiles 20,000. So if we start to see consumer numbers coming in a little bit lower than expected, we could see, yeah, that hurt Polaris' case.